If you've clicked on a video titled Australian Real Estate Tax Depreciation, I figured you must be extremely bored or in desperate need of the information in this video. So I'll get straight to it. And to be clear, I'm not talking about positive or negative gearing or anything like that. I'm purely talking about investment house depreciation claims. First, let's make sure I'm not wasting your time. To claim depreciation, the house needs to be an investment house. So if you're living in the house, you will not be able to claim this on your tax. So that's out of the way. Now let's get to the nuts and bolts of it. So there's two primary classes that we can claim depreciation on. The first is called capital works, and the second is plant and equipment asset depreciation. Whew. Now, if your house was built after September 1987, or the house has had a major renovation after that date, you'll be able to claim 2.5% of the cost of the works. It was picked as 2.5% as it should last for 40 years. So this obviously does not include the land cost, but you can claim the cost of the building costs. Items that fall into this capital works include the structural supports, walls, driveways, retaining walls, and a new garage or room. So this is pretty simple, but also bear in mind that if your house has not seen a timber builder since 1987, there'll be nothing that you can claim. So where it gets more complicated is the second category, which is plant and asset depreciation. Now these things can include things like carpet, hot water systems, washing machines, and the like. However, you should know that the cost can only be claimed if they're purchased as brand new. You cannot buy things second-hand for a house and then claim the cost unless you purchase it before May 2017. But the good news is that the costs are not calculated over 40 years, but instead they are calculated over the useful life. As an example, there's a $1,000 washing machine that was designed to last 5 years. You'll be able to claim $200 per year for 5 years, or that's using the prime cost method. There's another method of the depreciation known as the diminishing cost method. In this above example, you might be able to claim $400 in the first year, $300 in the second, $200 in the third, and $50 each in the last 2 years. So now I'll advise you of a very, very big trap to avoid. If you plan to live in the house for a year and then rent it out, bear in mind that any plant and asset depreciation costs will be voided, as you purchased it brand new for yourself, but it will not be brand new for when the first tenants move in. So if you have different tenants moving in and out, you'll still be able to claim it because it was brand new when the first tenants are in there. But if you yourself ever move in there, you'll basically void all the claims that you can make there. So with assets having a 20-year life and others having a 4-year life, and some using a prime cost manner to depreciate and others using a diminishing cost manner to depreciate, you can see how things get very, very complicated. If you have a new property, or if you spent a decent amount on a renovation, you're probably best consulting a tax depreciation quantity surveyor. You can DIY or use an accountant for small repairs and small renos, but if you've done something proper, as in the tens of thousands of dollars or more, it's best to call these professionals in. And yes, they can be very expensive, even up to $1,000, but at least this is an additional cost that you can claim on your tax as well. Now, I really hope that answered all your questions that you had in your mind when you clicked in this video, and have a nice day. Thanks.